Welcome to the Lowy Institute. My name's Mark Thirlwell. I'm the Director of the International Economy Program here. We have a very eminent guest today, Dr. David McCormick, who's Distinguished Service Professor of Information Technology, Public Policy and Management at Carnegie Mellon University. And in a minute, he's going to talk to us about the current state of the world economy, where we are, how we got there, and where we might be going. As an economist and an international economy watcher, it has a sort of a Dickensian feel about it at the moment. It's the best of times and the worst of times. It's the best of times in the sense that this is sort of an unprecedented opportunity to look at what the world economy looks like under circumstances of extreme stress and to see, frankly, quite amazing policy-style responses. Policy interest rates, nominal rates, driven down to zero or thereabouts in some of the world's major economies. The effective nationalization of large chunks of the developed world banking systems. We'd learned to talk a lot about globalization. In the last year, we've been hearing about deglobalization. A rapid decline in cross-border capital flows, for example. In the end, the final quarter of last year, world trade looked like it had almost fallen off a cliff. The first quarter of this year, at an annualized rate, world trade declined at something approaching 40% on the previous quarter. Truly dramatic changes. We've also had really significant shifts, I think, at the global institutional level, not least of which, of course, has been the emergence of the G20, of which we've had 2 meetings so far, and we have a third meeting coming up in New York in September. We've seen the US Fed take part in international central bank swaps, which were of a historic magnitude. And we've seen the resurrection of debates about the future of the international currency system, SDRs, which is sort of something that virtually nobody's probably heard of, except if they're sort of in this esoteric bit of the world that worries about the IMF. Suddenly got a shout from the governor of the People's Bank of China, and there's a talk about let's discover a new world currency. Even people are wondering about whether the yuan at some point will take over from the US dollar. Although, given the current state of Chinese financial markets and the lack of convertibility, that's clearly a long-term bet, but it's interesting that all these issues are now up for grabs. There's so much to talk about that I think we're very lucky to have, as a speaker here today, someone who's extremely well placed to do so. As well as his current position, Dr. David McCormick will draw on his experience as a US Treasury Undersecretary for International Affairs from 2007 to 2009, when he directly oversaw policies affecting global financial markets and helped lead the international response to the current crisis. Before taking on that role, he was Deputy National Security Advisor for International Economic Policy, and he was the President's personal representative to the Group of 8 industrialized countries. He's also served as Undersecretary of Commerce for Export Administration, where he oversaw policies affecting over $200 billion worth in annual high technology exports. And without further ado, I'll invite Dr. McCormick to the podium. Thank you.
It's my pleasure to be here at the Lowy Institute, and I thought what I might do is take the next 20 minutes or so and just give an insider's account of some of the decisions that were made in the United States and really within the international context over the last 6 months or so, really the last 3 months of the Bush administration and the first 4 months of the Obama administration, and then give you a perspective on what the outcome of some of those decisions have been and what the potential outlook for the global economy is going forward. Let me start, though, with just a little context for how I ended up being in the Treasury Department for the 18 months of this crisis. It started I was working in the White House, as was said in the introduction, and I got a call on a Sunday morning at 8 a.m., which should have been a red flag, from Secretary Paulson. And he said, listen, the guy I was going to have come into that role in the international is not going to be able to do that. I think you'd be great for the job, and here's all the reasons I think you should take it. So we went back and forth. I wasn't sure I was right for the job, but ultimately, by 8:30, we had concluded that I was right for the job. And I said, well, Hank, we should both talk to the president. I, of course, was working for the president, so I would need to go talk to him, and you would need to talk to the president about this as well. And Secretary Paulson said, I've already talked to the president. So the deal had been done, I just didn't know it, and I was happy to join the Treasury. Now the hard part came next, because I then went to my wife and said, good news. I've been working in the White House, I'm never home, we've got 4 little children, I've not been here to help, and I'm moving to the Treasury, which is going to be, and I remember this quote, and she's used it time and again, this is going to be a quality of life move. And of course, this was in July of 2007, which was the month before August of 2007, when subprime really started to hit. And of course, the next 15 months were just a sprint through what I think will be viewed as some of the most interesting, challenging, and significant times in terms of international economic policy in the past 50 years. And what I'd like to do today is talk very briefly about the 4 phases of the policy response to the crisis, with particular emphasis on phase 3 and 4, phase 3 being the last 3 months of the Bush administration and phase 4 being the first 4 months of the Obama administration. But there really were early signs that something was amiss in 2007, in the fall of 2007, and Secretary Paulson has told me and a number of people about one of his first meetings with President Bush, where he laid out his view that there was risk embedded in the financial system. He felt like there really was the possibility that we'd have some significant challenges over the remaining 18 months or so of the Bush administration, and that he used the term that there's a lot of dry kindling, but he wasn't sure where the match might be. Of course, no one, Secretary Paulson, none of us at the Treasury, none of us in the White House had any idea of the magnitude and the potential pace at which that risk would play out over the next 18 months. But because of that concern that he raised, when we saw early signs of subprime problems, there was a fairly, what we thought at the time at least, was a fairly aggressive response in 2 respects in phase 1. The first was a stimulus, which was somewhat controversial in the United States, but there was a fear that the economy was going to slow. We wanted to get out in front of it. So there was a $150 billion stimulus. That seems like small potatoes these days, but at the time that seemed like a big number. That was passed in early 2008 and rolled out in the spring and summer of 2008 in the United States. And then there was a whole set of initiatives to try to mitigate foreclosure avoidance. So that was the initial response. But of course, the situation worsened. And we moved into phase 2 really in the spring of 2008. And if you went to the time frame post the Bear Stearns situation in April-May time frame and looked out over the horizon, there were a handful of financial institutions that had dark clouds hanging over them. There were concerns about solvency. There were concerns about the exposure they had on their balance sheets. So Fannie Mae and Freddie Mac, for example, are quasi-government-supported housing financiers in the United States. Merrill Lynch, Lehman Brothers, AIG, Wachovia. These were the 4 or 5 institutions in particular that the market was demonstrating that there was great concerns. And if you would have sat in a conference room and imagined waving a magic wand in which you could have had resolution around those 4 or 5 points of uncertainty, it wouldn't have been crazy to think that by that uncertainty being eliminated, that would have a stabilizing effect on the market. And in the summer of 2008, that essentially occurred. So the government intervened in a very significant way in Fannie Mae and Freddie Mac, did things at the time that we thought were really aggressive in terms of putting in place a $200 billion backstop to address concerns that many investors had, particularly foreign investors, about the solvency of Fannie Mae and Freddie Mac. Lehman Brothers went into Chapter 11, which of course is an area that I think will be of interest to some of you. So we can talk about that in the Q&A session in some detail if you'd like. Wachovia was purchased by Wells Fargo. Merrill Lynch purchased by Bank of America. AIG was a recipient of a huge government intervention of $85 billion initially, and then a great deal more since then. And so all of those institutions had some sort of resolution one way or the other, and rather than playing a stabilizing or acting as a stabilizing force, this had the exact opposite effect, which is investors and counterparties around the world essentially said, if those institutions can be at risk, then any institution can be at risk. And therefore, there was a pullback on counterparty exposure. There was a reassessment of risk across the entire financial system, not just in housing-related assets, but in assets more broadly. And so that brought us really in mid-September to the beginning of phase 3, which at that time felt like we were truly staring into the abyss. And the week of September 13th and 14th, that Wednesday and Thursday, are particularly memorable days because on that Wednesday, we had been monitoring very carefully the money market funds. And the reserve fund, for those of you that follow this closely, had broke the buck. And what that meant was that investors who had long held the expectation that at a minimum their money market funds would return the initial level of investment, all of a sudden saw risk. And we saw a huge outpouring out of the money market funds. And you could, over the course of a day, as we were getting updates, see panic spreading across our financial markets, not just in money markets, but money markets was a leading indicator across every aspect of our financial system. And on a Wednesday night, we had a phone call in Secretary Paulson's office, and on the phone was Chairman Bernanke and Tim Geithner and a handful of other people, and it was clear that we needed to intervene in a very comprehensive way to try to stall the panic, to try to bring order to the financial markets, and have a comprehensive response, because the case-by-case responses that had been undertaken in Phase 2 clearly hadn't had the desired effect. So that Wednesday was the Wednesday before the Thursday morning where Paulson and Bernanke went across the street and briefed the president, and that evening they went up to Congress, and they briefed late into the evening the congressional leadership. And you all probably saw the press conference. Paulson and Bernanke came out, congressional leaders behind them, ashen faces. They had just been told that we're on the edge of a financial meltdown. The world as we know it may not be the same tomorrow. And it was an absolutely unprecedented moment. And that became the starting point for an effort to craft legislation that you all probably know as the TARP for initially $500 billion, then ultimately $700 billion that would be at the discretion of policymakers to put in place to try to stabilize the financial system. So that was in mid-September. Now, there was a lot of back and forth, as you may remember. The House in our country initially did not pass the TARP legislation, subsequently did pass the TARP legislation, and during those next several weeks, there was a huge amount of volatility in the financial markets. And this was a time at which the crisis, which had always had an important international dimension, was truly becoming international in many, many respects. And this all was leading into a very important set of meetings in Washington, which were held on October 10th, 11th, and 12th. That was the weekend of the IMF World Bank annual meetings. And the G7 met on that Friday. And then there was a series of G20 meetings. And the market was absolutely all over the place. In fact, the Thursday before that weekend, the equity markets, the indices dropped by 14%, which had been the largest drop since 1935 in the indices. So just to give you a sense of the feeling of the time, you all felt it here, I'm sure. That Friday was the G7 meeting. So imagine walking into the G7 room. There's 7 central bank governors, 7 finance ministers, 7 guys like me that are called the G7 deputies, and the sense of concern, fear, I don't want to say panic because I don't think it was panic, but it was absolute recognition that we were on the cusp of losing control of the financial system. That feeling was absolutely palpable. And to the surprise of many, that meeting, we started with this 4-page plan that we had worked all night on, and ultimately we all sat around the room and everybody said, this isn't going to do it. We don't like this. It's complicated. It's not clear. We haven't come together around how we're going to respond to this. And so we ripped up the paper in the room. And we literally got some direction from the finance ministers and central bank governors, and then 7 of us, my counterparts, went outside and we penciled on a piece of paper what the guiding principles for the international response was going to be. And it was 5 guiding principles and 3 sentences that sort of set up the thing. And that became the G7 statement that was released later. And the markets responded very well because for the first time, there was some clarity around how we were going to, at least within the G7, operate to try to stem the crisis. And of course, there was the questions, was there going to be actually substance behind this? But it was viewed as very favorable, and I think generally people were surprised with the clarity of what we had outlined. And then that Monday, the UK and the entire EU rolled out its plan that was consistent with those principles, and the next day, the United States rolled out its plan, a very comprehensive plan that was consistent with those principles as well. In the case of the United States, the plan had 3 pieces. The first was a whole series of liquidity facilities that the central bank had had been designing and put in place to try to bring liquidity to all the various parts of the credit markets that had essentially frozen. And by that point, they really were frozen. The second thing was an interbank guarantee. So allowing banks to lend between one another, because the interbank lending market is essentially frozen as well. And the idea was to get the interbank lending market working again and provide government guarantees that the government would protect or insure the senior debt that was issued by the banks. And that was really critical because there was potentially a run on the banks. And that wasn't just a theoretical possibility. We actually started to see some evidence that that might be the case within our country. The third piece was a capital injection program where we took $125 billion and put it into the 9 biggest banks. There was a lot of debate, which I'm happy to get into in the Q&A session, around whether we should buy troubled assets or put capital into those banks. We ultimately decided capital was the first step and was easiest to do and would be most stabilizing, and we could do it in a very quick and focused way. And that outline of those 3 paths are essentially the policy direction that has prevailed since that time. That week set the stage for the policies that are in place even today. It was also during that weekend, it's hard to believe when you sort of look at it now on a timeline, but it was also during that weekend that the seeds were sown for a G20 leaders meeting. And ultimately the president decided several days later, he met with the G20 finance ministers and central bankers in Washington that weekend and decided a couple days later that it made sense to do that. And so he had reached out to a number of world leaders, got feedback, and he tasked the Treasury and the White House with putting together a G20 leaders meeting on November 10th. And the purpose of that was to do it after the election, so it wouldn't be politicized, but soon enough where it could potentially have some impact in terms of also building further confidence. So that's the rough outline of what happened in that month from September 13th to October 14th, when the U.S. rolled out its comprehensive plan, is surely a month to remember, and one where some of the most consequential decisions of many decades were made. Since the Obama administration has come into office, I think you see the outline of a plan that's largely consistent with many of the things that were done previously, but probably bigger, more comprehensive, and certainly more expensive in a number of different dimensions. So just to look at the Federal Reserve, the Federal Reserve had initially put in place in the fall of 2008 a plan for quantitative easing where it would purchase mortgage-backed securities as well as treasuries of about $600 billion. And since that time, it's increased that commitment to $1.6 trillion. So we have, I think it's fair to say, an enormous amount of activity and a lot of very creative approaches that have been taken by the Federal Reserve, and that's continued under the Obama watch. The second thing that's been put in place is a stimulus that is about $800 billion in the United States. When we were considering the stimulus in early 2008, Larry Summers came by for a talk, and I remember very clearly the things he said about a stimulus needing to follow the 3 T's, which is targeted, temporary, targeted, timely, and temporary. And I think if you look at this stimulus, there's a lot to, I think, compliment in it, but I'm not sure it meets that criteria. Because if you look at the infrastructure spending, for example, of the $800 billion, about $100 billion of it, about 12%, is actually focused on infrastructure. If you look at the timing of it, about 60+%. These numbers are from the Congressional Budget Office in our country, which is largely, which is not largely, but is nonpartisan. So about 60% of the spending will take place in the first 19 months. So not quite as front-loaded, I think, as many people would have hoped. And it remains to be seen the degree to which some of that spending will remain after the stimulus is done. The design is for all that spending to be one-time spending, but there's a number of social programs in there that I think risk becoming permanent programs. If you look at the financial recovery plan that Secretary Geithner has rolled out, it's very much in line with some of the things that we were contemplating in the fall of 2008. So the question of how to buy these troubled assets and how to help clear the balance sheets of these troubled assets. And the plan he's outlined is a good plan if he can make it work. And the challenges we had that I think this plan will continue to struggle with is finding the market clearing price for those assets. So a price that the banks will be willing to sell them, particularly the legacy loans, which are on their balance sheets, as well as a price that the private sector is willing to pay. I think this has also been complicated by the fact that private investors are feeling like when they deal with the government, the deal keeps changing. And there are new restrictions on compensation and potential restrictions in the future on profit. And so as a consequence of that, there's a fair amount of uncertainty in the private sector about the benefits of doing business with the government, particularly as there's some sign that the economy has turned and that the need to act may not be quite as urgent as some had expected. The stress tests that have taken place in the United States have been a very positive development. And whether one agrees with the base case that was used in the stress test or not, the fact that 10 banks have raised $57 billion from private investors in the last couple weeks, of the $74 billion that the Federal Reserve said was needed from the stress test, that's a very positive development, I think one that bodes well for the future. And finally, the Obama administration has continued the G20 process, continued its role in the G20 process. And I think if you looked at the April meeting, which took place in London, I know here in Australia people follow the G20 pretty closely, I think it was a real step forward. So the specific efforts that are being undertaken on reform, the common guidelines that the G20 are committed to in terms of the reform agenda, the $1 trillion plus that the G20 has committed to the IMF, to trade finance, and to the multilateral development banks. These are all big steps forward. And I think the efficacy of the G20 in the future will depend on the degree to which it actually implements all the things that it said it was going to do, which will be not an easy thing to do, and the fact that it continues to take on tough issues like protectionism, which is a real risk. And unfortunately, many in the G20, including the United States, with its Buy American provisions in the stimulus, have undertaken protectionist measures since the economies have turned. And it also needs to deal with tough issues like global imbalances, which are a critical part of the reason we find ourselves in this situation in the first place, and they're an important part of the sustainability of the recovery. Addressing imbalances is going to be central to that. But overall, I think the G20 process is well underway, and I think that bodes well for the future in terms of a multilateral dialogue for trying to deal with some of these core issues. So what's it all mean? How much of it has worked? How much of it hasn't worked? What's the outlook for the future? And I guess from my standpoint, there really is some things we can point to as good news. The short-term lending markets have improved dramatically. The money markets and commercial lending markets have improved. If you looked at the credit default swap spreads, no one knew what those were 6 months ago. My guess is most of you are pretty familiar with those now. They've narrowed significantly. The banks have raised that new capital that I mentioned earlier, the CDS spreads for the banks I was referring to. Durable good orders are up. Corporate inventories are down. New and existing home sales in the United States are modestly up. Consumer confidence is significantly up in the last month. Equity markets are really up, and I'll talk about that in a minute. And the rate of decline, I think, just objectively, if you looked at a number of different metrics, the rate of decline is clearly slowing. Now, whether we're at the bottom or not, I think remains to be seen, but the outlook is improving. Now, the bad news is that there are very significant risks that remain. Risk spreads are still very high. Lending standards still very, very restrictive. The balance sheets of the banks in the United States still pose a very significant set of challenges. There already is a significant slowdown in economies around the world, and that will have a big impact on the strength of a recovery in the United States. Businesses and sectors are struggling, and I think it's fair to question whether the fundamentals and the price-to-earnings ratios that these companies are likely to be able to produce in the next 12 to 24 months in any way justify the kind of increase we've seen in the equity prices in recent weeks. And there's no doubt, at least within the United States, that unemployment, even if we are turning the corner, unemployment will continue to go up. It's a lagging indicator, and that will pose very real hardships for many in America. But even if you believe, as I do, that the economy will be growing again in the United States by the end of this year, or more likely early in 2010, I think there's some very significant questions about the longer-term outlook. And I think it's fair to say that it's very likely that the next 10 years looks very different than the last 10 years in terms of the economic growth model in the United States. And let me point to three things which I think pose particular concern. The first is, if you looked at the last 10 years, three significant drivers of growth are going to be much less robust in the next 10 years than they've been in the last 10 years. First is the financial services industry. So it's hard to imagine the financial services industry contributing to growth at the same level in the next 10 years as it has in the last 10 years given its current state. And it was a major driver of growth in the U.S. economy over the last decade. Second, the exports within the United States were a significant portion of the growth over the last decade as well. And even if the emerging markets return to significant growth and the rest of the world ultimately returns to growth, it's unlikely that that growth is going to be as robust and that export demand from the United States is going to be as significant a part of growth as it's been in the past. And finally, the consumption model for the United States, I think, is likely to take a very fundamental shift. So good friends of mine have warned me, never underestimate the ability of the U.S. consumer to spend beyond their means. But I think this is something fundamental. And I think what our country has lived through is beginning to make people question whether that kind of spending on personal balance sheets, given the wealth effect and the fact that many people within their homes and their 401ks have lost 40% of their wealth, it's unclear to me whether that spending pattern will continue at the same level in the future. And that has implications not only for the U.S., but for the rest of the world. So my argument would be that consumer behavior has changed and individual consumption has changed. Ultimately, that's a very good thing for our country because we need to have a higher saving rate, but that has implications for growth in the United States and around the world. The other thing that I think will pose a challenge for policymakers is inflation. So when the economy turns, the Federal Reserve will have to act in a very aggressive way to keep inflation in check. And so the two questions before us, will they get the timing right? Just as an analytic matter, as an operational matter, just getting that timing right will be challenging. But then the second question, and this is not directed at any specific policymaker, but will the political will be in place to do the things that will need to be done in terms of potentially raising interest rates and pulling back on all the liquidity that's in the market? Because taking those steps will ultimately further dampen growth. And so that's a fundamental question, and I think how it plays out remains to be seen, but my guess is inflation will pose some risk. The third area of concern is the deficit and ultimately the debt in the United States. So we have taken an enormously aggressive set of actions. I think those actions were necessary and well-founded, but the fact remains that they have very real consequences in terms of the fiscal outlook for the United States. And ultimately, the cost of servicing that debt is going to go up over time. Ultimately, if my outlook is correct and our growth is a little more anemic going forward than it's been in the past, then the tax base in the United States will be smaller. So you have a scenario where you have declining revenue, you have increasing costs, not only in the programs that government's put in place, but also the cost of servicing the debt, which is growing. And that's going to force some very tough trade-offs for policymakers. And they can do two simple things. One of them is they can reduce cost. The other is to raise taxes. And as tough as they both are, I think it'll be easier to raise taxes. And that ultimately has real implications for growth. So to step back, I would say that if someone had come up to me in October and said, we have a deal for you. On May 25th, we will hand over a situation where it looks like the economy is going to return to growth in the next couple quarters. We have pulled back from the abyss and a financial markets meltdown looks increasingly unlikely. And the outlook for growth over the next 10 years is probably not as robust as the last 10 years. I would have said, sold. I'll take that deal. That sounds like a good deal compared to what we're facing right now. So there's lots to feel good about, at least from where I think we were and arguably where we are. But there's no doubt that significant challenges lie ahead. We're living in what I think is a whole new world of policy choices and difficult policy trade-offs. I think those difficult choices and trade-offs are not unique to my country. I've spoken mostly about my country today, but I suspect some of those same challenges exist here and in other places. And so that will pose a set of very difficult choices. Now, from an American, you would expect, and I won't disappoint, you would expect me to end on an optimistic note, and I will. And the optimism, I think, springs from two things. First, within our country, within the United States, we have a long tradition of going through these very cathartic experiments of excess. There's a cycle of excess, of crash, and of innovation, and ultimately a return to a more robust economy than existed before the initial crash happened. And so out on the horizon, difficult to see, there will be new innovations, and there will be new drivers of productivity. There will be new industries created, whether it's healthcare, IT, or clean technology. It's very difficult to ascertain, but there's a generation of things that will happen in our country and in other places, which ultimately are not factored into that dismal outlook that I just gave you. The second thing that's different, and I think it's very different and very positive, is that the role of emerging markets in driving global growth is a whole new dimension to this equation. The emerging markets have been, I think, responsible throughout the crisis. They've been remarkably resilient in terms of how they've escaped some of the worst of the global downturn. And they will play an important part, not only in their own recoveries, but in driving the growth and recovery of the developed countries around the world. And that'll be a very positive development. Let me stop there. I'd be happy to answer any questions you might have in your mind. And again, thank you for joining us today.